is the Canadian economy faring amid international turmoil and a weak global outlook for 2012? Well, joining me now is an economist from TD Bank in Toronto, Diana Petramala. It's great to speak to you, Diana. Now, this week the Bank of Canada kept its benchmark interest rate unchanged at 1%. Was this in line with expectations at TD Bank?
We figured the Bank of Canada would want to keep interest rates at their current level, just given the economic environment. We're seeing financial conditions globally worsen, maybe not in Canada, but there's a potential for that to feed into the Canadian economy. So it's hardly an environment where the Bank of Canada is going to want to be heading down an interest rate hike path. At the same time, we're seeing rate cuts elsewhere, like in Europe, and very low rates still in the U.S. We wouldn't expect a rate cut from the Bank of Canada either, just because our domestic economy is growing quite firmly.
The central bank said economic conditions around the world are worsening, but not necessarily for Canada. What is your current outlook for the Canadian economy for the first half of 2012 and the second half of 2012?
Heading into 2012, we do think that worsening global conditions are going to feed into the Canadian economy, just because it's a small, open economy, very dependent on commodities and world trade. So we do think that a deepening recession in Europe is going to weaken demand for Canadian goods. As well, businesses and consumers are feeling a little less uncertain about the economic outlook, so we do think that's going to constrain some spending in the first half of 2012. Second half of 2012, we do anticipate that global conditions will start to improve. We do think eventually political leaders in Europe will, or hopefully they will put necessary policies in place to help ease the financial crisis currently underway there. And at that point, the Canadian economy should enjoy a nice rebound in economic growth.
We'll see Canadian inflation figures released at the end of the week. The central bank expects several significant upside and downside risks to affect the inflation outlook for the economy. Including oil prices, what are some of the upside and downside risks?
Well, definitely upside risk. Commodity prices have been quite lofty. I think this reflects some political turmoil in the Middle East. So that could put some upward pressure on overall prices. But Bank Canada looks at prices excluding oil and food prices because they tend to be volatile anyways. And on that front, I think on the upside is that we get continued firmness on the domestic front, which continues to push inflation up. Maybe a quicker than expected rebound in the U.S., which again will impact Canadian economic growth. If we have a quicker rebound or quicker growth than they expect in 2012, the inflation rate could be a bit stronger. On the downside is the potential for a renewed global recession. Just given the worsening financial conditions globally, we could potentially see some downside risk to economic growth and inflation.
So in that case, what kind of growth figures and inflation figures are you expecting to see for 2012?
We're looking for, in terms of growth, we're looking for slight moderation from 2011. We are anticipating economic growth in 2012 of about 1.7%. That's a very modest pace. And for inflation, we're expecting inflation, just given the modest outlook for economic growth, we're expecting a bit of inflation. We're expecting inflation to start to wane into 2012, and we're looking at about 1.5% for core CPI. The Bank of Canada targets 2%, so a bit weaker inflation outlook for the year.
In terms of growth and economic recovery, as well as the effect of headwinds in Europe, how does it differ in Canada to the US?
The US has tighter financial linkages, so the US banking system and overall financial systems being more affected, and availability of credit is being more affected maybe by the financial turmoil, whereas Canada is more dependent on its trade. So exports make up a greater share of our economy. So we will be more impacted through our trade linkages. But in terms of what happens domestically in the U.S., domestic demand is very, very, very depressed relative to pre-recession levels still. So there's a lot of pent-up demand in the U.S. So we could see continued economic or growth being driven by domestic figures in the U.S., whereas in Canada, we're being hit with a negative shock at a time when our domestic economy has become more vulnerable to such shocks. We just, over the recession, thanks to low interest rates, have built up a significant amount of vulnerabilities in household debt. We have high levels of household debt in Canada is one of them, and some froth in the housing market. Our home prices are 10 to 15% overvalued, so that leaves households and domestic spending relatively vulnerable to a potential economic shock in 2012 relative to what you would see in the U.S.
Thank you very much for speaking to Dukascopy TV, Diana. For more interviews on developments out of Europe and a closer look at currency projections from some of the biggest banks in the financial industry, make sure you stay tuned to Dukascopy TV. Goodbye for now.